Hazanov, and I'm a realtor with Keller Williams Realty out here in Denver, California. And today we have a special gathering with my best colleagues here at the round table, and we are going to discuss all things real estate. Different scenarios, what's in, what's out right now, interest rate, financing, and all kinds of questions that we get from buyers and sellers nowadays. So stay tuned, and if you haven't subscribed yet, please subscribe to my channel and hit the like button.
You can't go 100 yards in any direction without hearing someone talk about real estate these days, right? Rates are at their lowest they've ever been. We hear, ads on the radio. Rates. I've been in this business for 21 years in the mortgage business. I've never heard ads, quoting 1.5%, right, on rates. It's absolutely incredible. And so I appreciate you inviting us in to discuss some of these topics and some of these things that get so confusing, and consumers need to understand, right, how to interpret some of the things they're hearing, right?
Yes.
So thank you for the opportunity to be here.
Thank you for coming,
Yes.
and all of you to joining us today.
Thank you.
Yes. And if you don't mind, so I'm Todd with Cross Country Mortgage. And Melinda, can you introduce yourself real quick?
Sure, I'm Melinda Thielen with Old Republic Home Protection, and I do the home warranty part of your homes.
Excellent. And then we have another top producing realtor, Jim.
Hi, Jim Anderegg, also here at Keller Williams.
So if you don't mind kicking this off, because this one is, I go to sleep thinking, hearing these radio ads, and I want to talk about what people are hearing on the radio, and in terms of APR especially, and interest rates, right? And it's easy for me, because every loan officer does it, to say, well, APR is one of those things that's just so confusing, and there's no way to, in fact, if you look it up on Wikipedia and try to read the description, it doesn't make any sense, right? So I want to share a really quick tip for people that they can take home with them, and actually the next time they hear an ad. And that tip is this: if you know the fixed rate that's being advertised, and then subsequently the APR, right, in this radio ad or online ad, those two things have to coexist, right? If you're quoting a fixed rate in the ad, you have to say, by law, the APR, okay? If the APR being quoted is 0.06 to 0.08 higher, okay, than the fixed rate, there are points involved. There's additional fees involved, okay? And so, great example, I heard an ad just the other day for a 15-year fixed at 1.75%, okay? The APR quoted was 2.06. So that ends up, if you subtract 2.06 from 1.75, you get 31, right? 0.31, what we call basis points, okay? And so I ran real quick math. That ends up being almost 3 points, okay, to buy down the rate, okay? A point is a percentage of the loan amount. And so if you're looking at 3 points on a $500,000 loan, for example, it's $15,000 of out-of-pocket costs to get the rate of 1.75. Okay, so the nugget that people can take is if they do the math in their head and it's 0.06, 0.07, somewhere in that range. It's not exact because the loan amounts are different. Or dramatically higher than that, there's going to be points built in, right, or costs, origination fees. So I want people to understand that, those spreads mean something, and to be able to say, oh, that's 31.31 difference. There's a lot of costs involved in that.
I have a question though.
Please.
About that. So you're saying it's $15,000 for those points?
Mm-hmm.
Is that something that could be added into the loan, so you're not really paying it out of your pocket right now because you don't have that kind of money?
For sure. So, and if you were to call, they would tell you, oh yeah, you don't have to pay anything out of pocket, right? No closing costs out of pocket, and then we'll just roll it into the loan amount, which is not necessarily a bad thing, right? It might actually be worth doing, but you need to say, okay, first of all, you're going to pay interest on that $15,000 for the rest of the term.
Oh yeah.
Right. So let's say it's a $500,000 loan. You now have a $515,000 loan. And so you're paying additional cost every month for the next 15 years on that extra cost. And the simple math to determine whether it's worth it is if you take that payment of whatever X dollars and subtract it from the payment that doesn't include points, right? So let's say the no points rate is 2.25 and the payment is $350 difference. You just divide that 15,000 by 350 and you'll get a number. That's the number of months it takes to earn it back.
Okay.
And in my opinion, if it takes more than 3 or 4 years to earn back the cost of points, it's
Doesn't
generally not
worth it.
worth it.
Right.
Yeah. So, but I've seen, like that ad, for example, it was, I mean, you were like 10 years into the loan before you started earning back the savings. And so, there's nothing illegal about those ads. You know, they're doing their job and they want you to call, right? But I think it's important for consumers to know, you know, kind of what they're getting into. There's no free money, right?
Yeah.
There's nothing free about anything.
There's always the
Yes.
little fine print that you need to look for.
Yeah,
Right.
yeah,
That's the
exactly.
catch.
Yeah, it's capitalism at its best.
Yeah, of course.
So
What is
I have
the-
another,
oh,
oh, go ahead,
Another
Jim.
thing, what is the advantage in using a mortgage broker or mortgage banker like you as opposed to, you know, I have a great relationship with my local bank and going into my bank?
Yeah, that's a great example, or a great question rather. You know, the simplest way to explain it, there's 3 ways to get money, home financing, in the industry. There always have been. Up until the 80s, there was only 2, but after the big banks got into, you know, I can't name any names, but the big depositories got into mortgage banking in the 70s and 80s because it was really profitable, right? Prior to that, it was just credit unions and brokers. So there's 3 ways to get money. The big banks is one, right? And if you walk into a big bank, you get financing from that investor, right? And they're not going to shop necessarily. They're going to give you the quote, and they're going to tell you, you know, here's what your option is. Many times, the big bank may have the best rate, right? Because they're a high volume, right? And I think big banks represent probably 65-70% of all loans, right? So, yeah, it's a pretty big number. At least it used to be. And so, because the margins can be thin because you have such volume, right? Sometimes the rates can be better with a big bank. The second way is brokers, and so a broker is someone who sits in a desk in an office. They take your file and they pre-underwrite it with their own knowledge, right? They don't have an underwriter sitting down the hall, right? So you're trusting their interpretation of your ability to borrow based on their knowledge and wisdom. They send your loan out, right? And so while brokers have great value in the industry, in many cases they lose control, right? So the appraisal process is out of their control, the underwriting is out of their control. The third way is what we call mortgage banking. And mortgage banking is similar to a big bank in that they're direct to the money, right? So you have underwriters, you have processors under one roof, and so loan officers can typically, you know, massage the transaction a little better than a broker can. Pricing is going to be similar to a big bank because they're direct to Fannie Mae and Freddie Mac, and you have a little bit more flexibility with regards to getting a transaction done.
Okay.
So we're with them, you know, cross country as a mortgage banker. I recommend if people are shopping around, you know, using mortgage banking because the pricing is very competitive and much more, we can do things faster typically.
Okay.
But that's a very good question.
I have a question for you. I have a friend who's going through a divorce, and the husband kind of wants to move out of the state. He's tired of California.
Yeah.
He wants to get out of here, and you know, the wife wants to stay in the home
Yeah.
with their 2 kids and stay in the same school district and keep the kids here, which is what they've kind of agreed upon so far in their divorce, but it takes a long time because
Yeah.
they're still arguing over lots of things.
Yes.
So is there any way that they can get money so he could go on his way, so to speak, and she can stay in the house and
Yeah.
you can work things out? I mean, do they have such loans like that to help them?
Yeah, Linda, I'm so glad you asked that. So now that COVID is kind of, well, we hope coming to an end soon. Many non-conventional or unconventional loans are coming back into play. One of which is what I call the 9 loan. It's actually, I named it that. I'm so proud of myself. I'm just kidding. But it doesn't have a name necessarily. It just has a factor that allows for a borrower to not disclose income or employment. Okay. Now, when there's no income and no employment on the loan, right? And I'll get into the how we're able to do this. And there's no ratios involved. That means there doesn't need to be, in the case of the remaining spouse, right? They don't have to have income involved, which typically they wouldn't have, right? And so we can actually finance to their name to allow them to stay in the home and get the departing spouse off the mortgage, right, and off title, and they can go do their thing, and then the remaining spouse can stay in the home, right, with the kids and keep them in the school district and whatnot. And it's very unique financing. There's a license that actually originated in 1993 by the federal government that allows small banks to utilize this certificate. It's called CDFI. There's only 2 lenders I know in the nation that do this, and we have access to one of them. And the CDFI certificate allows for this investor to remove income and employment when there's equity, right? When there's good credit, right? And when there's reserves, when there's money in the bank post-closing, right? And so we use this loan for self-employed borrowers, right, and all sorts of other niches, but helping two spouses that are going through this, very tumultuous time, to be able to separate the asset like that is unheard of, revolutionary. Because what you just described, and I kind of jumped to the conclusion when we should talk about the challenges, right? If a spouse wants to remain in the home, and there's going to be spousal support and child support, it's not going to become usable from a financing perspective until probably 12 or 18 months later.
Right.
So that means both spouses have to be on the mortgage, right? And if they sell the home, where do the remaining spouse and the kids go? There's just so many unknowns, right? And that's the way it has to be done right now. And what this loan allows is for us to finance, right, before that occurs, before that income is usable, which is it's truly unheard of.